Hey everyone, this is the sixth video of the series in terms of the technical aspects, not including the introduction. This will be the final video for how I do my weekly trade analysis on the pairs that I trade, the markets I trade, I should say. For those of you that are just joining us, please start with either video 1, the introduction, or video 2, which gets into the beginning of how I determine these technical levels. This is a comprehensive, cumulative video series, and if you've missed any of the earlier ones, it's going to be a little bit confusing. In fact, if this is your first video, you're probably not going to know anything of what I'm talking about. You're not going to know where any of these lines are coming from, and I'm not going to go over it because we already did that in the earlier videos. So please feel free to watch those. Everything will be explained in the earlier videos. So at this point, this video is going to cover classical Fibonacci retracements. Okay, and in the USD CAD, I don't think we're going to have a whole lot of well we will. There will be some opportunity for retracement here. Unfortunately, since this video segment series only analyzed the supply side of things, we're only looking for areas where we think price will start to turn and go down from. So in other words, we'll be taking short orders. Basically there is no retracement that's occurred. I mean, the only retracement we have here is from the high here, okay, of last week to the low of last week. That is in fact the swing high to the swing low. That's how I draw my fibs. So just to be redundant here, I would start at the high, take it down to the low, and drop it there. But we already have it drawn, as you can see. Normally this isn't the case. Normally I have, a situation where I, can say, oh, well, let's, take the high and the low there, and then we've also got, we can take, a swing low to a swing high there. But in this case we don't, just because the way the USD CAD has been moving up so much recently. So really, the only levels that I would be looking at are the same ones here, and the only thing that falls within on a weekly, swing low to swing high, or I should say on a daily chart, swing low to swing high, is this 78.6% retracement. So that's, again, that adds further confirmation that will be a level that price, will have a reaction from. And when I say reaction, basically price will turn and go the other way. If I were to draw any other real significant swing lows to swing highs, that's pretty much it. There's nothing really obvious on the intraday, and I don't focus on that, so I focus on the larger term. If I were to draw, retracements from the move up, it would be something like this, from this high, to probably around this low here, or even more significantly and more relevantly, I would draw, I could do this from here to there, and those would be levels that I would be looking to take. But in this case, we don't have any fresh demand levels until all the way down here, and so I simply wouldn't be looking to do that at this point in the week. Now, if price were to drop all the way down, and if we were able to get down, I would say, right between this 38.2 and the 23.6 level, in here, I might start, figuring out smaller term Fibonacci retracements and Fibonacci extensions. But for this week, that's it. So that's it. So this is the fib retracement. So what we've done here, guys, to summarize everything in this last video, is go through a checklist of an analytical approach to find out where the highest probability opportunities occur that price will turn. Okay, that they'll reverse when it hits those prices. And trading is basically, successful trading is a function of one basic concept. It's finding statistically valid opportunities or statistically valid situations in a market that are both valid and significant. In other words, they provide more than average reason for price to react a certain way as it goes through that level or as it touches that. And then we stack them on top of each other. I'll give you a real statistic. Between the inception of the euro in 1999 and or at least I don't know if that was the actual inception of the euro, but that was definitely when it started trading on the foreign currency exchange, as at least according to the record I read. And 2006, so you have about a 7-year block. There was just over 2,000 trading days for the euro US dollar. And speaking about importance of pivots, the S1 level, which was support 1, was held support about 56 to 58% of the time, if I recall correctly. Within price, that was the daily low for that day. Within 1 pip of the day, 56 to 58% of the time. It was also the daily high. R1 was your daily high about, I think, 57 or 58% of the time. R1 was the daily high. So just off of knowing S1 and R1, you can know that if you've come within 1 pip of S1 or 1 pip of R1 and prices start to reverse, that you've already got a 56 or 58% chance of that being the high for the day or the low for the day. So if you're only a little bit down from there, you can go ahead and take a short. If you're only a little bit down from R1 as an example. So that's one probability where you have a 6 to 8% edge. 56 to 58% to know that price will react around that level, and that will establish the low or the high. So that's one. The second thing is, if you look where we have a daily supply zone, where between these two blue lines, where that was a period of basing before price broke down fast, and we've never been back up there. So anybody who got long here, and believe me, 90% of forex trading is institutional, and not everybody going short here was institutions. They don't all call each other. They're trading against each other just as much as we are. So it's there's losing positions there, and when institutions lose, they don't just get out at market. They wait for price to come back. They scale out, and when price moves back in there, not only do we know that there was more supply than demand, there was more sellers than buyers, as a matter of definition, because price dropped. Okay, there had to be more sellers than buyers for price to drop out of that. But we also know that we've never retraced back into it, which says that there's people with open positions, or even institutions that lost opportunity. Maybe they didn't go short when they should have or wanted to, and they'll go ahead and take advantage of that opportunity when price gets back up there. The first time it gets back up there is the best. So that's a now we know in this zone there's a higher likelihood of being more sell orders than buy orders. Period. We've pinpointed exactly in this zone, where previous daily highs and lows were. Those are exhaustion points. That's places where price could not go any higher because there were just no buyers there. Well, if people didn't find value to buy there last time, they probably won't find much value to buy there this time. So again, even a higher probability that price will turn around those highs and lows. You have a low basically here at 0.505. You have a high here right around the I think it's 0.570 price, and you have a high there. So the high, the top of this yellow line, this zone here is kind of in between the zones, and this one really, if I were gonna say really just a little below the zone, those are likely turning points. Okay, so again, now we've got another probability in our favor. We also have drawn our Fibonacci's, and we see that we have a Fibonacci retracement. The 78.6% level falls right here, which is within our daily supply zone. Fibonacci retracements, they do work. They show relative overbought and oversold conditions much better than any other indicator does. And so we have, like here as an example, we have a Fibonacci level that happens to be, a previous daily high, that happens to be in a range before price broke down from, that hasn't been retraced to. So we have all these things stacking, and then between, let's say, these two yellow lines, that's our first zone that we really want to take a sell on, and these two yellow lines is a zone where we really want to take a sell on here as well. Go short, and in these cases we've got a weekly resistance pivot point. I think it was R1, and we have here this gray dotted line is a daily resistance pivot point. So we already know the daily resistance pivot point. If price reaches that within 1 pip, on come market open, that if it reaches that level, we've got a 56 to 58% chance of that being the high of the day. Period. No questions asked. I mean, that's just the statistics. Well, now mind you, I'm actually taking this out of context. That statistic was performed on the Euro US dollar. This is the USD CAD. Okay, so it's not exactly the same. I don't know exactly how effective it is. But you can bet that that's going to be a level of institutional interest. And with that being the case, there's a higher likelihood of a turn down. So what we're doing here, again, in summary, is we're just stacking probability on top of probability on top of probability. We're finding out where things are really overbought and are really oversold, where there's likely to be more existing seller buy orders at the overbought or oversold areas, along with, let's say, daily relative highs and lows that are determined by pivot points, as well as Fibonacci retracement levels. So once you stack all this up, if you find something where you have all of these factors line up with, okay, you can, with high probability, know that price will likely turn once it reaches that level. Now, I've not discussed how I actively manage trades or exactly how I set my orders. That's not what this series is about. I want to give people a framework of analysis to start to understand, how they can, do go through an analytical process and have a step-by-step method that they can go through, that you guys can go through, essentially, and start picking out where you might want to take trades, where you have a high probability of price turning in your favor. You can risk for every dollar you risk, you can plan on gaining at least $1 to $2, I would say, maybe $3, and maybe even more. And in the same vein, you can be right 60% of the time. I mean, my statistic for my trading last week, I had an exceptionally good week in terms of my percentage of wins, but my winners were actually a tiny bit smaller than my losers. I actually I think my losers were about 5% more expensive than my winners won, so I lost a little bit more than I made on each trade, but I had 73% successful trades. So it was a very profitable week. That was just last week. But anyway, you get the idea here, and you can actually see this is a real-time analysis. I don't know what the future holds, so we will actually get to see how these levels hold up and how they work as price reaches them this coming week. So I'm excited for that, and that concludes this series. If you guys have any questions, you can email me. My email address is eremarket@yahoo.com. I'll spell that out. It's E as in Eric, R as in Richard, E as in Eric, the word market, M as in Mary, A as in Adam, R as in Richard, K as in kite, I as in Irene, I'm sorry. I can't spell this. I'm trying to do a letter by letter spelling here. I'm losing track of it. So anyways, it's E as in Eric, R as in Richard, E as in Eric, the word market, like supermarket, just the word market, at yahoo.com. Feel free to drop me a line if you have any questions or want to know more specifics or anything like that. Again, I didn't really talk about how I manage my trades or where I take my exits, how I move stops up or reduce risk, which is the other half of the equation. But this gives a good foundation to start with. So I find for beginners, a lot of times they're looking to find just where the heck is a good place to even enter. Well, now this is a method that you can use to find over this coming week a good place to enter. Thanks. Hope you all got something out of this, and I'll be continuing with other videos as the weeks go on.